Hi everyone, welcome back to Saheb Academy. Today in this 11th video of Internal Reconstruction chapter, we are going to solve our 9th problem as you can see over here. And the question is from ICAI study material, illustration 8, Recover Limited. That's the name of the question. And the interesting thing about this question is here we have got a debenture adjustment, right? Debenture holders are taking over the freehold property. So it's going to be interesting. And then contingent liability adjustment is there. We are paying off contingent liability and getting insurance. All right. And then one important discussion we are going to do at last regarding bank overdraft. Okay. Which is very important. You can say it's kind of a hidden adjustment. All right. We'll do that at last while preparing the balance sheet. Fine. Now let's get back to this question. Let's see what do we have over here. Now see here. Recover Limited decided to reorganize its capital structure owing to accumulated losses and adverse market condition. Okay, the balance sheet of the company as on 31st March 2021 is as follows. So here we have been given the balance sheet and notes to accounts. So first we have share capital, note number 1, 3,50,000, which consists of equity share capital and preference share capital. 20,000 equity shares we have, the face value is rupees 10, 2 lakh in total. Preference shares are 15,000, 8% cumulative preference shares of 10 each, right? That's 1,50,000. In the bracket what they are saying, see, preference dividend has been in arrears for 4 years. Yes, of course, preference dividend has not been declared. It is in arrears. It's a loss-making company, right? It's going for internal reconstruction. How can they declare dividend? So it is in arrears. Fine. Okay. Moving on, then we have reserves and surplus, note number 2, 70,000 negative. Negative means what? Loss, right? See, reserves and surplus, profit and loss account, debit balance. Debit balance means loss. How much? 70,000. So what we are going to do about this? We are going to write it off in the big entry at last. You all know that by utilizing capital reduction account, right? Okay. Next, see, we have long-term borrowings, note number 3, 50,000. So in long-term borrowings, you can see 10% debentures secured on the freehold property. You see, debentures have a specific charge on freehold property, right? And there is an adjustment regarding that. We'll come to that. Okay, 50,000. Fine. Then see current liabilities, trade payables 80,000, short-term borrowings, bank overdraft. How much bank overdraft do we have? 90,000. Okay, we will have a discussion at last about this. Fine. Then see other current liabilities, interest payable on debentures. You see, interest payable is also there. Yeah, we have not paid the interest to the debenture holders. How much? 5,000, right? So if the question talks about debenture holders, you have to understand in your mind that they are not just talking about 50,000. No. How much amount is, owed to debenture holders? 50,000 and this 5,000. In total, 55,000. Is it clear? Okay, understood. Yes. And then come to the assets, non-current assets, property, plant and equipment, note number 4, 3,35,000. You can see PPE. Note, freehold property we have of how much? 1,20,000. Leasehold property 85, plant and machinery 1,30,000. Okay, fine. Then we have intangible assets, note number 5. In intangible assets, what do we have? You can see we have goodwill of how much? 50,000. How can a loss-making company can have a goodwill? They can't have a goodwill. Yeah, they shouldn't. So we are going to write it off in the big entry, whether the question says or not. Even if the question doesn't say, we will write a note down below in the question and we will write it off. Is that clear? Okay, fine. So that's simple. Then we have non-current investments, note number 6, 40,000. So if you see the note, non-trade investments at cost 40,000. That's simple. Okay. Then see current assets, inventories are there 30,000, trade receivables 50,000. All right. So this is the balance sheet. Now see here we have the scheme of internal reconstruction, the adjustments also you can say. Let's just see what do we have over here. Subsequent to approval by court of a scheme for the reduction of capital, the following steps were taken, right? We have 7 adjustments over here. And at last they are saying you are required to show the journal entries, fine, necessary to record the above transaction in the company's books and to prepare the balance sheet after completion of the schemes. Yes, we'll do that. So one by one, let's go through this and let's just pass the journal entries. Okay, let's begin. Now see here we have the solution. Let's understand how we are going to pass the journal entries in the books of Recover Limited to give the effect of scheme of internal reconstruction. Okay, so let's see the first adjustment. See here, the first adjustment is the preference shares were reduced to 2.5 rupees per share, right? Let's see in the old balance sheet what is the face value of preference shares. Face value of preference share, you can see 10 rupees. Yes, how many are there? 15,000 preference shares are there. So if the face value has been reduced, then what do? We always cancel the old capital completely, then we create the new capital, isn't it? So scrap off, cancel the old capital. How much? 1,50,000. How will you cancel the old capital? Really easy. We are going to debit the old capital because capital has credit balance. To cancel, we will debit it. Yes, 15,000 into 10, that's 1,50,000, debited and cancelled off. Now we have to create the new capital of how much? See, preference shares were reduced to 2.5 rupees per share. How many preference shares are there? 15,000. So 15,000 into 2.5, that is equal to 37,500. This is the new preference share capital, right? So how will you create? Simple, credit it to 8% preference share capital account, 37,500. Easy. 15,000 into 2.5, that's what we did. Now whatever is the difference between these two, that is the gain for us. Yes, that will go to capital reduction. How will you calculate? Simple, 37,500 minus 1,50,000, that is equal to 1,12,500. Yes, that will go to capital reduction account, or you can say reconstruction account, whatever you like. Fine, simple. Then what? We are done with the half of the first adjustment. Then they are saying, and the equity shares to rupees 1 per share. Equity share face value also we have to reduce to how much? To 1 rupee, right? If we see in the question, what is the face value currently of equity shares? See, 20,000 equity shares are there. Face value is rupees 10 each. Yes, 2 lakh is the total capital. So from 10 we have to come to rupee 1. So face value is changing, no, completely scrap off the old capital. Yes, debit the old capital entirely. Equity share capital account debit 2 lakh. Easy. Now to create the new capital, what you will do? Really simple, 20,000 equity share into 1 rupee, the new face value. Yes, that is equal to 20,000 only. Isn't it? Simple. Yes, what is the difference between these two? 1,80,000. 2 lakh minus 20, that is 1,80,000. So that is the gain for us. That will go in capital reduction to capital reduction account. Is it clear? Simple and straightforward. Then what is happening? We are done with the first adjustment completely. Then they are saying one new equity share of rupee 1 was issued for the arrears of preference dividend for past 4 years. Yeah, we have seen in the balance sheet that preference dividend is in arrears for 4 years. Yeah, so let's just calculate how much is that amount. How will you calculate that amount? You all know they have given the name. See, 8% cumulative preference shares. So 8% is the rate of dividend. No, 1,50,000 first you will take the total capital value into 0.08, that is equal to 12,000. This is the dividend of 1 year. They have said 4 years it is in arrears, right? So into 4, that is equal to 48,000. This is the amount they are talking about, which is in arrears. Yeah, we have not declared the dividend. There is no liability payable in the balance sheet. Yeah, nothing. It has been just disclosed over here. Even if the question has told, let's just say that, it has been sacrificed, we don't have to pay anything, we would have completely ignored it. No journal entry, nothing. But here the question is not saying that preference shareholders have sacrificed this amount. No. Yeah, they have not said it has been sacrificed, this 48,000. What the question has said that company is giving them equity shares of rupee 1 for this 48,000. Yes, so now we have to pass the journal entry for that, isn't it? Yes, we have to pass the journal entry. So what journal entry? Simple, we are giving the shares to them, equity shares, so we will credit the equity share capital. Really simple. But how? See, understand, 48,000 is the amount of dividend, no, of 4 years, They are saying rupee 1 equity share. So divide by rupee 1 you will do. So you will get to know what is the number of shares you are going to give them. How many number of shares? 48,000 shares you are giving them. Is it clear? 48,000 shares of rupee 1. Is it clear? So the entry will be very simple. This is kind of a loss for us, isn't it? So this loss has to be borne by capital reduction only, right? So see here, to equity share capital account 48,000. You have issued the capital, no? So you are crediting the equity share capital account 48,000. Yes. How 48,000? I told you 48,000 shares into rupee 1, 48,000. And the entry cannot be handicap entry. What would be the debit? Debit would be capital reduction. Debit cannot be preference shareholder or something like that, or dividend, because nothing is there. In our books, nothing is there. It is just a disclosure over here. Yeah, nothing is there. Nothing has been recorded. No dividend has been declared, nothing. Fine. That is why only capital reduction can come over here, the debit. Fine, understood. Then what? 3 adjustments are done. Then we have see the third one. Yeah, 2 adjustments are done. Third one is still pending. See here, the debenture holders took over the freehold property at an agreed figure of 75,000 and paid the balance to the company after deducting the amount due to them. Now understand first, how much are we, due to debenture holders? Yeah, how much we have to pay to debenture holders? I told you in the beginning only. See, in the balance sheet, debenture value is 50,000. Yes, and interest payable is also there on debentures, 5,000. So total we are due to them is how much? 55,000. We owe them 55,000, isn't it? Yes, our liability to debenture holder is 55,000. They have taken our freehold property. Why? Because they had a specific charge on it, right? Secured on the freehold property. So they took the freehold property and let's just say they have sold it. Understand like this. They have sold it themselves or they have purchased it only, right, for 75,000. Yes. So understand 75,000 is the value, right? From this they deducted their amount. Their amount was how much? 55,000. Our liability to debenture holder is 55,000. So they deducted that. And then whatever remaining amount is there, 20,000, that remaining amount they gave it to us. Do you understand this? Because freehold property is ours, no? They took it because they had a specific charge on it and they deducted their liability. And remaining amount they paid us in cash, 20,000. Is it clear? This is what has happened. Now you have to, put this in a journal entry, all right? And then you will understand how much gain and what is happening. It's really simple. Let me just show you how it will happen. You understood the calculation? The calculation was really simple, no? See, this is dividend in arrears calculation that you already know. Come to the, freehold property we had of 75,000, agreed value. Debenture holders took that. And then the total liability we have to reduce from that, 55,000. Yes. So 20,000 we have received from debenture holders, right? Our freehold property is gone. We don't have freehold property. Our liability also gone, debenture and interest. Fine. So we have to pass the journal entry for this. So how journal entry will pass? Really simple. Liability is gone, no? Debit the debentures. Yes. Liability is paid, no? Debit the debentures. 50,000. Debit the payable, interest payable, because that also we, settled, right? So yes, so debit that. Then what is gone? Then we have received 20,000 also. Yeah, in this transaction, we have got 20,000 from debenture holders. We have received. If we receive, then what do? We debit the bank account. Yes. And then our freehold property is also gone. But freehold property was not of 75,000. Freehold property was of 1,20,000. Yeah. Completely freehold property is gone, no? Yeah. So we have to remove it from our books also. So if you see the question, freehold property is of 1,20,000. Can you remove just 75 over here? No. Partly it has not been taken over. Yeah, completely it has gone. Debenture holders have taken over that, right? So we have lost that. So see here, to freehold property 1,20,000. Yeah, you will credit, no? Asset is gone from us. To cancel the asset, you have to credit the asset. Then whatever will be the balancing figure, that will be the capital reduction. In this case, what is happening? We are incurring a loss because of this transaction of 45,000. Okay, so that will be debited to capital reduction account. Do you understand this? Yeah, see, it's really simple. 1,20,000 was the value of our freehold property. Debenture holders, you know, what did they do? Debenture holders took that freehold property, yes, and you know, they paid us 20,000 for that, minus 20,000, and then they said our liability is completely settled by this. 55,000 liability was there, yeah, I mean our liability to debenture holder, yes, so that is reduced, isn't it? So that is equal to how much? 45,000, yes, so still 45,000 loss we are making because of this. Do you understand? So that will go to capital reduction account. Is it clear? Simple and straightforward, right? We did this just to calculate how much money we have received. So we put that in the journal entry, then we get to know how much loss we are incurring over here. Fine. Yes. So fourth adjustment also you understood. Then the next adjustment, see here, fourth one, plant and machinery was written down to 1 lakh. Okay, this we will do at last in the big entry. Okay, let me just mark it right now so that I won't forget later. Known trade investments were sold for 32,000. Now this fifth adjustment is really simple. We are selling off our investments. So let's just see what is the book value of investments. See here, 6th note, non-current investment, non-trade investment at cost 40,000. It has been sold, right? This is the cost. Cost is 40,000. It has been sold for 32. Okay, we are selling it at a loss. Yes. So if we are selling it at a loss, then 8,000 will go to capital. I mean, it will be written off by the capital reduction. Yes. So see here, really simple. We have sold it for 32,000. So we will receive how much money? 32,000. So see, bank account debit 32,000. But the asset, the investments were of 40,000. So 40,000 you will credit. Yes. And the balancing figure will be the capital reduction account, 8,000. Really simple entry. Yes, you all know this. Fine. Now after this, what do we have? After this we have an adjustment of what? Goodwill and obsolete stock included in the value of inventories of 10,000 were written off. So here the question is specifically telling you goodwill written off. So we don't have to take any decision, right, regarding the intangible, regarding the goodwill. Yes. So we will write off the goodwill, no problem. And then obsolete stock of 10,000 they are saying. So we have to, you know, write off the inventory by 10,000. We'll do that, but we will do this at last. Okay. Yes, we'll do this in the big entry. These two we have to do at last. Fine. Next adjustment, see the seventh adjustment. A contingent liability of which no provision had been made was settled at 7,000. Okay. What does that mean? It means there was a contingent liability, right? And we paid it. Yeah. It was settled at 7,000. So let's just pass the entry of this settlement. We are making the payment. Really simple, right? See here. Contingent liability account debit, yes, to bank. We made the payment, no, 7,000. Why did we pay? We paid because of contingent liability. So contingent liability will be debited. Is that clear? But understand, then in the same line, what they are saying, see, and of this amount, 6,300 was recovered from the insurance. So how much recovery is happening? 6,300. So what is the actual loss for us? Actual loss is 700. Yeah. So next entry we are going to pass about this. See here, it's really simple. This contingent liability we will completely scrap it off. Yeah. It will be credited to contingent liability 7,000. Okay. We have received from the insurance company how much? 6,300. So bank account will be debited. Whatever is the difference between these two, that is a loss that will hit capital reduction account. Is it clear? Simple and straightforward. So this is how you have to do it. Yeah. Contingent liability is not there in the balance sheet, nowhere, right? So we are making the payment and it has to hit the capital reduction account only. Luckily here insurance company came in between. So 6,300 recovery happened. Otherwise complete 7,000 would have hit the capital reduction account only, right? Let's just say insurance is not there. Then what entry would you have passed? Really simple. Reconstruction to bank. Yeah. You would have passed that entry. Really simple. Is it clear? Because of insurance company, we got 6,300. Fine. Understood. Now what? Now all adjustments are done, right? Just these two in the big entry, we will pass that. So how we will pass the big entry? You all know how to pass the big entry. First, we have to calculate how much amount is there in capital reduction account. Yes. So in capital reduction, how much do we have? Let's calculate from the beginning. See, capital reduction, here it has been credited. Credited means plus. So 1,12,500 plus, then again capital reduction credit of how much? 1,80,000. So 1,80,000. Then here debit of capital reduction 48,000 minus 48,000. Yes. And then capital reduction debit over here of 45,000 minus 45,000, right? And then here when we sold off the investments, here also there was a loss of 8,000, so minus 8,000. Yes. And then because of contingent liability, how much was the loss? Because of contingent liability, the loss was of 700. Yes, so minus 700. Debit means minus, credit means plus regarding the capital reduction. So that is equal to 1,90,800. So this is the balance we have in capital reduction, right? So we are going to utilize this now in the big entry. So debit the capital reduction by how much? 1,90,800. Is it clear? Okay. Then what you are going to do? Then whatever you have to write off, you will write off now. Yes. So first, what do we have? First, we have that loss, no? 70,000 was it? Yes. See, reserves and surplus 70,000. Profit and loss account debit balance 70,000. Let's just write that off first. To profit and loss account 70,000. That loss had debit balance, no? To write it off, you have to credit. Is it clear? Okay. Then what do we have? Then we have the adjustments, no? Adjustment first, they said plant and machinery was written down to 1 lakh. Written down to 1 lakh, right? Check in the balance sheet what is the value of plant and machinery. Plant and machinery value is 1,30,000. So from 1,30,000 you are coming to 1 lakh means 30,000 reduction. Yes, so 30,000 will be credited over here. Yes, to plant and machinery 30,000. Is it clear? Okay. Then goodwill is written off. Yes, so goodwill is how much in the balance sheet? In the question, goodwill is of 50,000. So 50,000 you will credit goodwill completely. Yes. Then what? Obsolete stock of 10,000 were written off. Where is this obsolete stock? In the value of inventories. So you will credit the inventory by 10,000. Is it clear? Yes. They didn't say to 10,000. They said obsolete stock is there of 10,000 only. So 10,000 only we have to reduce. You have to be very careful here, whether they are saying to or they are saying by, right? You know that already. Okay, understood. So we have done that. Then what? All done? Yes, all done. Now what we have to do? Now we have to calculate, yeah, how much is left in capital reduction that we have to take to capital reserve. Yeah, 1,90,800 minus 70,000 minus 30,000 minus 50,000 minus 10,000. That is equal to 30,800. 30,800 will go to capital reserve, isn't it? Yes. At last, this will go over here, balancing figure. Fine. So we are done with the journal entries. Really simple and straightforward, isn't it? Yeah. There was no any other fictitious asset or anything. Yeah, like discount on issue of debentures, isn't it? Any other fictitious asset like underwriting commission. Yeah, nothing else. Just this fictitious asset was there, the accumulated loss that we have written off. Simple. Yes. So journal entries completely done. Now let's just see the balance sheet. Okay, how we are going to prepare the balance sheet after the reconstruction. Now see, here we have the balance sheet after the internal reconstruction. At the top, first thing you have to write in the bracket and reduced, isn't it? Yes. Now how to do this? It's really simple. I have told you first you have to take the old balance sheet, the question one, and then in this give the effect of journal entries that you have just passed, right? You will automatically get this balance sheet. Really simple. Let's start. First we had share capital, isn't it? In the question, note number 1, we have equity share capital, preference share capital. What happened to equity share capital? You all know we reduced the face value to ₹1 each. Yes. So see here, share capital note number 1, equity share face value is ₹1. And then what? Old capital completely we scrapped off. The number of shares were 20,000 only. But then what else we did? We also issued equity shares to preference shareholders also, isn't it? 48,000 shares we issued of ₹1. That was 48,000 only. Yes, so that will get added. 20,000 plus 48,000, that is equal to 68,000 shares. Yes, so 68,000 equity shares of rupee 1 each, 68,000. Clear? Simple and straightforward. Then what happened to preference share capital? Preference share capital also the same thing, right? The number of preference shares didn't change. It remained the same only, 15,000 preference shares only. Yes, but the face value was rupees 10. From that we changed it to rupees how much? 2.5. Yes, so see here, 15,000, 2.5. So if you multiply that, that is equal to 37,500. And then, you know, in other question you always have to check whether we have issued any more preference shares and all. Yeah, but here no such thing has happened, just this, right? 37,500. so that will come. Old preference share capital is completely scrapped off. Is it clear? Okay, note number 1 clear. Then if you check in the question, then we have what? In the question we have reserves and surplus, note number 2, 70,000. Is it still there? No, 70,000 is gone. We have written it off. The loss, profit and loss debit balance. In place of that, what has come now? Because of the big entry, what has happened? Because of the big entry, now we have got capital reserve of 30,800. So this will come over there, no? Yeah, isn't it? So after reconstruction balance sheet, we will have how much? Capital reserve 30,800. Is it clear? In reserves and surplus. Simple and straightforward. Then what else do we have in the question? Check. In the question we have then long-term borrowings. In long-term borrowings we had debentures. Do we still have debentures? No, we have, you know, completely settled the debenture, isn't it? Debenture also gone, interest payable on debenture also gone, debit cancelled off, isn't it? It is settled. So now it will not appear in the, you know, after balance sheet, isn't it? Post balance sheet. So long-term borrowings, nothing. Is it clear? Yes. Then what else do we have after long-term borrowings? See in the question we have trade payables. Did we touch trade payables in the scheme of reconstruction? No. 80,000, it will be there as it is. Trade payables 80,000. Clear? Easy. Then see we have short-term borrowings, bank overdraft. Did we touch bank overdraft? Did something happen regarding bank overdraft? Nothing happened. Right now just let's take it as it is, and then I will, you know, explain you what we are doing regarding bank overdraft. Now let's just take it, bank overdraft 90,000 as it is. Okay, bank overdraft 90,000. Is that clear? Yeah, the question didn't tell na pay the bank overdraft or anything, nothing. So just as it is. Fine. After that what happened? Other current liabilities, interest payable on debentures. This is settled. This will not be there in post balance sheet. Yeah, it's not there. Simple. So everything has been covered over here. Then come to the asset side. Property, plant and equipment. In property, plant and equipment, our freehold property is completely gone. We don't have this 1,20,000. Yes, yeah. So see here, property, plant and equipment, note number 3. If you come over here, we don't have freehold property. Leasehold property, did we touch anything? No. So this will be there, 85,000 completely over here. See, leasehold property 85,000. What about plant and machinery? Plant and machinery, we have written it down by 30,000. 30,000 reduction has happened in the big entry. Yes, so you know, plant and machinery reduce 30,000 from that 1,30,000. So that would be equal to 1 lakh plant and machinery. Is it clear? Yeah, simple. Okay, then what? We are done with PPE. Then come to the intangible assets. See here, intangible asset, note number 5. In intangible asset we had goodwill. Do we still have goodwill after reconstruction? No, goodwill has completely been written off. So we will not have intangible assets only over here, right? Simple. After that we had non-current investments in the old balance sheet. How much? 40,000. So this 40,000, do we still have it? No, investments are sold, isn't it? We passed a journal entry for that. Yes, investments were sold for how much? 32,000. But investments are gone, no, completely 40,000 has been credited and cancelled off. Yes. So in the new balance sheet, you know, investments will not be there. See, no investment. Yes, you can see over here, no investment. Directly current assets are there. Yes. So if we come to the current asset in the old balance sheet, inventories, how much was it? 30,000. But you know, from inventories we have written down 10,000 obsolete stock. Yes, so 30,000 minus 10,000. 30,000 minus 10,000. Yeah, that will be equal to how much? 20,000. How this 20,000 came? Do you understand? Is it clear? Simple and straightforward. Then what? Then trade receivables are there. Okay, let's just check the old balance sheet. In the old balance sheet, trade receivables 50,000. Did we touch trade receivables? No, nothing, right? As it is. So as it is, see 50,000. Clear? Simple. Then in the old balance sheet, do we have any cash over here? No cash, right? No cash. But because of internal reconstruction, what did we do just now in the journal entries? Do we have cash? That's what we have to check now. We don't have cash from the beginning, but because of the scheme of reconstruction, we have to see whether we have cash or not now. Yeah. So see here in the journal entries where bank account is coming. See, bank account is coming over here. Debit of how much? 20,000. Yeah. So plus 20,000. Plus 20,000. Okay. And then what? Then see here 32,000 debit is coming again when we sold off the investment. So plus 32,000. Is it clear? And then what did we do? We paid off the contingent liability. No, we paid off the contingent liability 7,000. So minus 7,000. And then from the insurance company we got 6,300. So plus 6,300. Yes. And then yeah, that's all. Yes. So that is equal to how much? 51,300. Yeah, 51,300 cash balance we have, cash and cash equivalents. So that will come in the post balance sheet. See here, cash and cash equivalents 51,300. Can you see? 20,000 plus 32 minus 7,000 plus 6,300. You see, separately they have taken cash and cash equivalents over here 51,300. Yes. And then bank overdraft separately at the top 90,000. Why is it separate? If you remember, we have solved illustration 3, A and Company Limited. There what did we do? There we have set off. Do you remember? Yeah, we have set off. Yeah, ICAI illustration 3. In the new syllabus also it's illustration 3 only, A and Company Limited. We have set it off. So why it has been set off over there, and here why are we not setting off? Understand what ICAI is doing. Let me just tell you right now. Yeah, let's have that discussion which I'm talking about. Yes, the balance sheet is over. Yeah, you understood, no? Everything we have discussed. How did we do this? And it is tallying 3,06,300. Here also 3,06,300. Simple, right? Let's just talk about that bank overdraft adjustment. Yeah, whenever the question is silent, sometimes what happens is question is completely, or what do you say? It gives you instruction that you have to pay the bank overdraft. At that time we make the payment, we make the entry, what, bank overdraft account debit to bank. Yeah, we pass the entry, 90,000 payment we make, isn't it? Like how we pay the bank loan, that entry we pass. But here what is happening is, understand, the question is silent. Question has not said anything, like in illustration 3 also. Yeah, and then in practice question 12 also you will find the question is silent, the question is not saying anything. Yeah, so what will happen is, you have to take a decision whether you will set off the bank overdraft with the cash and cash equivalent or you will not set off, right? That's the decision you have to take. So it's really simple. How will you take the decision? You have to follow the ICAI, right? So see here, what will happen? You will have two cases over here. Let me just show you. See here. Case A is bank overdraft in the question is 1,95,000. Okay, this is the example of illustration 3, A and Company Limited. Okay, bank overdraft in the question is 1,95,000. all right, in the old balance sheet. And then when you do the whole journal entries and everything, you get to know how much cash is left with you. Okay, cash left at last due to internal reconstruction is 2,30,000. So what is happening? The cash and cash equivalent, the balance is more than the bank overdraft in the question. At this time, what do? We set it off. Yeah, as I have done in the illustration 3, you will see that's what I have done. See, bank overdraft has credit balance, isn't it? It's like a loan, no, short-term loan. And this has debit balance because this is our cash balance. So we will set it off. 2,30,000 minus 1,95,000. Yeah, that's what we did, isn't it? And we got 35,000. 35,000 will come in balance sheet as cash and cash equivalent. Is it clear? We'll set it off and show, right? Simple. Bank overdraft will not be shown separately at the top in the current liabilities. Yeah, in short-term borrowings, it will not be shown. Just here it will be set off and it will be shown in cash and cash equivalents. Do you understand? Like this presentation will happen. Balance sheet, cash and cash equivalent 35,000. And this has happened, as I said, illustration 3, A and Company Limited. Is it clear? But in this question, yeah, in this illustration 8 of Recover Limited, what is happening? Here, if you see, where is the question? Bank overdraft is how much? 90,000. Okay. And then the cash balance we found out how much after doing everything. The cash balance we found out to be 51,300, isn't it? Roughly, if you calculate from the journal entries, you will get to know that, right? So 90,000, 51,300. This is the case B, where bank overdraft is more than the cash left at last due to internal reconstruction. So in this case, what ICAI does, ICAI has done in two problems like this. Okay, what ICAI does is ICAI doesn't set off or net off. Yeah, it doesn't do that. What it does, it shows them separately. Bank overdraft in short-term borrowings as usual, and this in cash and cash equivalent. Okay, see, short-term borrowings, cash and cash equivalents. ICAI doesn't set off and shows them separately. Fine. And you can refer the illustration 8, the current one which we just solved, recover limited, or you can see the practice question number 12 also. This is what they have done. Yeah, there is a scenario where bank overdraft is more than the cash. Is it clear? X limited question, practice question number 12. Is it clear? So you have to keep this in your mind. Sometimes the question specifically says that you have to pay the bank overdraft. For that you will pass the journal entry, and bank overdraft of course in the post balance sheet will not appear. It is gone. But if the question is silent, then you have to see which scenario you have in the question and do accordingly, so that you won't lose any marks. Is it clear? Simple and straightforward. You understood this? Yeah, this hidden adjustment. Okay, simple. You understood the balance sheet also, right? Really simple and straightforward. So that's all for this video. I hope you have understood everything. See you in the next video. Bye.